Hi there, welcome to kneppyinvests. We are told all the time that we should be investing in the good companies for the long term and staying well clear of the bad companies. But the question is, what is the distinguishing features to determine whether a company is bad or good? Could be a lot of factors. Maybe it's management, maybe it's pricing power. It could be something as simple as a really good product, maybe growing revenues over time. Maybe it's just share price moving up through time. That is the determining factor whether a company is good or bad. And this is a topic I want to discuss in the future because this is something really important that we as investors need to determine whether a company is good or bad. And in today's video, I am going to be looking at a specific company who released an announcement to the market, saw the share price drop something like 18%. And this announcement really clarified to me that this company is a bad company, not the sort of company you really want to invest in for the long term. Now, I will be evoking Warren Buffett, and I absolutely believe what Warren Buffett says. And he says the very factor I'll be discussing in this video is the most important factor in determining whether a company is good or bad. So let's go back to about 2011 or 2012. And Warren Buffett he was interviewed in regards to the GFC. And in one of the interviews, he had a fairly insightful quote. And this is the quote, or a bit of the quote he used. I'll talk about the rest of the quote in the next slide. And he's determining what makes a very good business. Now, I'm going to say a very good is exactly the same as great. This is what makes a very good or great business. The single most important decision in evaluating a business is pricing power. Now, I have done a lot of research on this, and I am coming to the conclusion that Warren Buffett is absolutely right, that this is the most important decision we have as investors. It's all about pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And this is actually becoming more relevant today with inflation. If you have a business who can raise their prices without losing business in this sort of environment, they will maintain their profits. If on the flip side, if you have a business who will lose customers if they raise their prices, they are going to suffer during high inflation times. So pricing power becomes even more relevant in high inflation times, which we might be experiencing right now. I'm not sure how long we will experience inflation for, but right now it's fairly important. On the flip side, what makes a bad company? And that particular quote I mentioned in the previous slide actually does continue. And if you have a prayer session before raising the price by 10%, then you've got a terrible business, which for me is exactly the same as bad business. So it all comes down to pricing power. If we can determine whether a company has pricing power or not, we can determine whether a company is good or bad. And in fact, the next statement he made during this interview, he was talking about Moody's. He took a position in Moody's, and the interviewer asked him, "What about the management in Moody's?" And Warren Buffett actually said he has no idea about the management in Moody's. That's not relevant. It's all about pricing power. So for those who say that the biggest determining factor what makes a company good or bad is management, well, Warren Buffett actually disagrees with you. And I actually would listen to Warren Buffett over anyone else when it comes to investing. Now to the example of a company which I consider a bad company on the ASX, and that is Decmil. Now, this company has been around for 40 years, which for me is a selling point for them, but it's not a selling point for me. I don't care if you've been in business for 40 years, 20 years, 10 years, 5 weeks, 100 years. That does not, or is not a determining factor whether you're a good business or bad business, because there will be or are companies right now who have been around more than a century who I think will eventually go broke. Anyway, Decmil delivers integrated construction and engineering solutions across the infrastructure, resources, energy, and construction sectors. And right away, as soon as I read that, I knew this company would have low margins. But having low margins is not necessarily bad thing. And I'll talk about that during the rest of the video. The most important thing here is whether or not Decmil has pricing power. And how do we determine whether a company has pricing power? And that is something I will be discussing during this video. Now, with Decmil, I actually am a shareholder of this company, and this was a big mistake. And one of the reasons I became a shareholder of this company a long time ago was simply because the share price had tanked a lot. And I thought maybe there was some good value here. So I do follow this company quite closely. Now, my holdings in this company are fairly low. So I'm not really concerned about the share price falling from here. I just find that I'm learning a lot from evaluating what Decmil is doing, also evaluating their financials. And one of the things about Decmil is the amount of contracts they're always announcing, just a plethora of contracts. Every week, it seems like Decmil announces a new contract. And in the half-yearly report that they did release February 24, 2022, they listed all the contracts they did sign. And this is just a few of the contracts that they did were awarded in the infrastructure area and the resources area. For instance, an award of 88.7 million contract, 25, 28.2, 23.3, 7, 8, $300 million, 110, 400 million. Now, this was not the only amount. This was not all the contracts they had won. It went to another page. And every time I read an announcement from Decmil in regards to a new contract, the first thing that comes to mind is, but what are the margins you have in this contract for you to win, for you to undercut your competitors? I've already talked about how Decmil has low margins. And all we have to do is look at their profit and loss statement, focusing on revenue, cost of sales, and gross profit to know this company has extremely low margins. Now, one of the things I do for most companies is look at the growth in revenue. And when you look at the revenue growth for this company, it is actually quite impressive. But there's something that really takes away from an impressive revenue growth, and that is the growth or lack of growth in gross profit. So when I look at financial statements, I usually start with cash flow statement and then work my way back. And the cash flow statement is not pretty looking. The company also did a couple raising, so they had to raise cash. So even though they had a lot of revenue, they did have cash flow problems. They also increased their debt as well. So those are not two good signs. But when I look at the profit and loss statement, I'm only focusing on the top part of this statement. I don't care about the profit. All I want to know is revenue, cost of sales, and gross profit in determining whether a company has pricing power. Now, let's just zoom in on those three most important factors I am looking at in determining whether a company has pricing power: revenue, cost of sales, and gross profit. There is potential some investors will just look at the revenue growth, and that is the very first thing I always look at when it comes to a business. Can they grow their revenue through time? And Decmil has shown over the past year they have been able to grow their revenue from 165 million to 226 million. So straight away, you might be saying that's amazing growth. And when you also include the amount of contracts they have been awarded based off that half-year report information, you think maybe this could be an investable company. But if you dig a little bit deeper and just look at the cost of sales, there is a significant red flag there, because cost of sales, which is really important to the day-to-day running of the business, has grown at a greater rate than the revenue, increasing from 146 million to 212 million. The way I looked at cost of sales, which could also be called cost of goods sold, it's the critical expenditure needed for the day-to-day running of a business. So we're talking about the labor, say, on the factory floor. If there was no labor on the factory floor, there will be no revenue because nothing would be produced. If you took away the CEO, business, day-to-day business would keep on churning. So the CEO is not critical for the day-to-day running of the business. In fact, the CEO's salary is not included in the cost of sales. That would be included in administration, that sort of thing. So that's the way I look at cost of sales. It's very critical for the day-to-day running of the business. So if you take away the cost of sales from the revenue, you get gross profit. And gross profit is something I always look at. And for the past year, the gross profit for Decmil actually fell from 18.9 million to 14.4 million. So straight away, we know that the gross profit margin, which is also very important, is significantly low for this company. Now, I already determined by what this company does that we knew the margins in this business were going to be low. But low margins in itself does not determine whether a company is good or bad. For instance, Costco has really low margins, but their competitive advantage over their competitors is the low margins. So that does not mean Costco is a bad company. Aldi probably has significantly lower margins than Woolworths or Coles. That does not mean that company is a bad company. That is their competitive advantage. So the next thing I always look at is gross profit margins, and that's fairly easy to calculate. You just divide gross profit by revenue, times it by 100. And I always want to see the trend in gross profit margin. This is the most important thing when it comes to gross profit margin, the trend. So you take 1 year in isolation, that tells you a few things, but it doesn't tell you the whole story. And if we go back to 2020, the gross profit margin in this particular half year for Decmil was 11.5%. In this most recent half year, it was down to 6.4%. That is a significant red flag for me. Why am I interested in gross profit margin? And this becomes very important in determining whether a company has pricing power, because gross profit margin and margin stability signifies pricing power. And it all comes to this. So if you have to buy some supplies to create your gadgets and you have to spend more and more for your supplies, but you can't raise the prices, that would mean your gross profit margins is falling. But if you have to spend more for your supplies to create your gadgets, and you can raise your gadgets by actually more than what you're paying for the supplies, that means your gross profit margins actually increasing through time. And that is saying you actually have pricing power. So the movement or the change in gross profit margins over time is the main determinant in whether a company has pricing power. So I'm always looking at the movement in gross profit margins over time in a company. It's one of the things I look at all the time. Because I look at gross profit margins, the history of gross profit margins through time, I decided to have a look at Decmil's gross profit margins through time over the past 10 years, looking at half yearly data. And it does show you a horrifying fact in regards to this company, that this company is a bad company. In fact, gross profit margins have fallen from 30% 10 years ago to a current about 6% in the last half year. But the other thing to notice here is the market cap of the company, which I've included in this particular graph. I just want to see the correlation between gross profit margins and market cap. And there is a pretty good correlation there, because the market cap of this company has fallen from 450 million 10 years ago to a current market cap that's less than $30 million. This says 50 million, but that's at the end of December, the last half year. And the market cap of this company has fallen even further. So you can just see the decrease in gross profit margins over the past year has led to a decrease in the valuation of this company. I just want to touch upon two important points again. I've already mentioned this. Low gross profit margin does not equate to a bad company. I've already mentioned Costco already. So Costco, I would consider a pretty good company. In fact, if you look at their gross margins, it's fairly stable. It doesn't change with time. But if you compare the gross margins of Costco to Walmart and some of their competitors, it is actually lower. But I'll actually say that Costco is a better quality company because of their advantage of providing goods at a lower price than their competitors. But what I do look at is change in gross profit margin. If I see gross profit margins falling through time, that is a bad signal and an indication of a bad company. If I see gross profit margins stable, or better yet, growing through time at a fairly nice, consistent low rate, that is a sign that a company is developing pricing power. One of the main things that a company has for pricing power is brand. For instance, Coca-Cola can raise their prices and people probably will start buying more, maybe not more Coca-Cola, but they will continue buying Coca-Cola. And McDonald's probably another good one. So brand recognition is really important. So over time, sometimes a brand will become more recognized and they can raise their prices. I think Apple is a perfect indication or example of that. No doubt, if you go back to when Apple first started selling whatever they started selling, someone might have mentioned to someone else, "Are you buying an Apple computer?" And they would have been a joke about, "No, I'd rather buy an orange." But over time, Apple is now recognized as a manufacturer of iPhones, iMacs, all those sort of gadgets. And it is regarded as high quality stuff, particularly among those who love Apple. So that is an example of a company that has pricing power. Now, pricing power doesn't mean you can raise the price of an iPhone from $1,000 to $10,000 and you maintain your customer base. More than likely, a lot of Apple customers will turn to their competitors because that's a ridiculous price rise. But over time, you can maintain raising your prices of your goods because you have that brand recognition. You have that pricing power. That's really important. Now let's get to the announcement that was the inspiration for this video. And that was a profit downgrade for Decmil. So this company is seeing their gross margins falling through time. And the worst thing a company can do, above all else, is release a profit downgrade. You want to see companies release profit upgrades. That's what you want to see, not profit downgrades. This is why the share price fell another 18% on the 8th of April. So Decmil revises financial year 22 financial guidance and announces management changes. I'm not going to talk about the management changes, but they did have some excuses. And those excuses were supply chain issues, price escalation. So those two words together just, proves that this company has no pricing power, and border challenges have caused losses on several contracts. They also mentioned in the main crux of the announcement that increasing labor costs have had an issue too. So you've got increasing labor costs, increasing prices they have to pay for supplies, those sort of things, and they can't raise the prices of their contracts because they probably sign on the dotted line that that's how much they'll get, which means they have zero pricing power, and they will be affected by increasing cost of supplies, increasing wages as well. So they've revised guidance for revenue. It was, forget what it was, but it's down now to 425 to 450 million, which seems a lot for revenue. But remember, this company has extremely low margins. And they've also revised EBITDA down to be negative 10 to 15 million. So even though they have a large amount of revenue, this company will probably not be profitable, not cash flow positive in the next financial year, the current financial year. Then they became a little bit more positive, saying potential upside from contract claims, and their CEO, Dick, probably one of the most interesting names on the ASX, will transition from the business and Queensland management team bolstered with 2 key appointments. So that probably means absolutely nothing to me because I don't care who's in charge of this company. This is a bad company. And over the last 10 years, no matter who's been in charge of this company, they can't, no matter what they do, show that this company can increase their gross profit margins. So 10 years of fails from this company. And that is being shown in the market, falling from over 450 million to a current market less than 30 million. Now let's have a look at the charts for Decmil. Absolutely ugly looking charts for this company. So this is the daily 1-year chart for the company, and the share price just keeps on dropping. So even though I am a shareholder of this company, I find this quite amusing because my holdings in this company are really low. So I am learning a lot from this company. So I am following what this company does. And even though this was a mistake investing in this company, I think it's really good to be optimistic that you can learn things from any mistakes you had made. So don't be neglecting mistakes. Try to learn from your mistakes. That's very important. And I am learning a lot with Decmil. The share price of this company has fallen from about 55 cents to a current share price of 13.5 cents in the past year. So even though they have significant amount of revenue, and I would be impressed with revenue between 425 and 450 million, just low margins makes this company seem really attractive right now at a market cap of less than 30 million. What could go wrong? But I think there is a possibility that this company won't be in existence in a few years. Doesn't mean this company will go broke, but I think there is heightened risk in that regard. And the Decmil story becomes even uglier when you look at the weekly chart over the past 10 years ago. Now, 10 years ago, in 2012, the share price of this company was as high as $32. Well, in fact, it wasn't, because the company did do a price consolidation. I think it was a 10 to 1 or something like that. So the price went from 5 cents to 50 cents, if I remember correctly. I could be completely wrong. But the biggest thing to take away from this particular chart is if you were a long-term holder of this company and you've held shares over the past 10 years, say you bought, say 100 shares, no, 100 shares, 100 shares of this company back in 2012, you spent $3,000. Those 100 shares right now at 13.5 cents is $13. So your value of your holdings in this company has dropped from $3,000 to $13. That is the very definition of wealth destruction. You don't want to be holding a company that is wealth destroying or destroying your wealth. You want to be the complete opposite. And that's the very definition of a bad company, that it is able to destroy your wealth. That's all I have for this video on the anatomy of a bad company, looking at pricing power. I believe that pricing power is one of the most important determinants in figuring out whether a company is bad or good. And we did have a look at Decmil, and we have seen the value of this company drop like a rock over the past 10 years because gross profit margins have fallen during that period. So I do look closely at gross profit margins, whether they're rising or falling through time. It's one of the most important distinctions I will make in determining whether a company is good or bad. In fact, in my opinion, I should be focusing on pricing power, on gross profit margins, probably more than I'm doing right now. If you do have any questions about my video today, I'd love to hear it. If you have any questions about Decmil, what you think is the most important determinant or most important aspect in determining whether a company is good or bad, I'd love to hear it. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.